Hello, and welcome to our Forecast Event 2023. My name is Trevor Wilde. I'm a CEO and investment advisor here at Wilde Wealth Management Group, and we're happy to have you join us today. The Forecast Event is the event that we've been doing for about 15 years now. It's one of a two-part series, our Forecast Event that we hold in February of every year. The second part, which we will hold in August as a follow-up to the Forecast Event, and the second part series. Many of you have attended this event over the last 15 years, and we're happy to have you on our conference again today. For those of you who haven't been on this Forecast Event before, I thought I'd take just a quick second to walk you through the purpose of today's discussion. The Forecast Event and most of the information that we're going to look at today was really going to be based on 2022. We explore what happened throughout the course of the year, how the markets fared, economic conditions as we went through the course of the year. And then we're going to end the discussion with some topics and conversation around what's predicted for 2023. And again, some of the economic indicators and things that we'll be watching that might drive how 2023 fares. The halftime report, which we hold in August, will be a follow-up to that, where we get a chance to look at the first half of the year and explore what happened and how close the pundits were to what they predicted. As before, all the information that we provided today was pulled together at the end of the year. I'll give you some talking points because as I'm recording today on February 8th, a lot of things have happened so far. We're about 40 days into this year, and it's been an exciting one already in a much different feel than last year. But before we get into the meat and potatoes of tonight's event, I thought we'd take just a few minutes to put a name or a face with some of the names that you know here at Wilde Wealth Management Group. You know, oftentimes clients will call and you work with a lot of our team members over the phone or via email. But we wanted to be able to put a face with the name. So I'm going to take just a quick second and talk through or just to introduce some of the folks. Our leadership team here at Wilde Wealth, again, I'm Trevor Wilde. I'm the CEO of Wilde Wealth Management Group. Jackie Yoder is our Chief Operating Officer. Janine Lackey is our Chief Compliance Officer. Jackie joined us in 2000, about a month before the pandemic hit. She's been an amazing resource and just a really great leader in our team coming through the pandemic. Janine Lackey has been with us for about 13 years and joined us many years ago and is a valued team member as well. Our investment professionals have grown. These are all of the folks in our Scottsdale locations. Some of you may or may not work with these advisors. I'm not going to go through each name, but you'll have them here up on the screen and you get a chance to see all the amazing professionals that work as part of our team. And also for many of you who've been with us for 20 and 30 years, we often hear people say, well, gosh, there's a few more people as a part of the group today than there was 10 years ago or 15 years ago. And really the emphasis that we've had is continuing to grow by adding professionals that can help elevate the level of service that we do and that we provide to you. And then we broke it down by office. So many of you, again, if you've been with us for a long time or you may or may not be aware, we do have a Glendale office. We have 2 full-time advisors in that Glendale office. Our Sedona office, we have 3 advisors that cover the clients from that Sedona office. We have 2 advisors in Payson. We have a Tucson affiliate. We have 3 advisors in our Tempe office. And about a year and a half ago, we opened an office in San Luis Obispo with 1 advisor, Robert Scheib. So those are some of the folks that work in the different offices. The real important people are on the screen now. This is your client services team. These are the people that make it all happen. Again, I'm not going to go through them name by name, but we've added some really amazing professionals, and we just have such an amazingly talented group of people. And I'm so thankful for each and every one of them that are a part of our team and for the work that they do to help support you and what we do on your behalf. And I want to say thank you to them. Administrative team continued. These are folks that do a lot of other things outside of the face-to-face. Our marketing team, Kayla, I want to say a special thank you to her. She puts a lot of effort in with Sarah in getting our podcasts and these webinars ready to go and out to you. So I want to say a special thank you to them as well. And just a quick second to brag on our organization. I'm really proud of how much impact we're having in the community. And up on your screen, we've got some of the awards and recognition points that we've been awarded the last couple of years, which I'm incredibly proud of. But I'm more proud of the impact we're having in our community. And that would be on the right side of the screen. We've kind of highlighted some of the impacts that we've been able to have directly into our community across the state of Arizona in particular. And I also want to say thank you to you. Much of what we were able to do was because of you. We did quarterly outreach campaigns with you, and many of our clients participated, whether it was the Toys for Tots toy drive or the backpack drive. Our clients continue to amaze me at how giving you are and how important that is to give back to the community. And we're really, really, really proud of that. I'd be remiss not to say that we're also very proud of being ranked number 2 in Barron's, ranked number 2 in Forbes. And we continue to work very hard to retain those ratings and meet your expectation as your advisors. We've also added a handful of affiliates, and some of you might work with some of our affiliates, so you'll know the people that you're working with, but we thought we'd highlight them on this screen here. And then the last portion here, one of the things that makes us different, and we've really tried hard to incorporate, is other professional services as part of our organization. And not so much as just someone that we could refer to, but these are professionals that are in our office that we work with daily that we can help coordinate, whether it's Mike, our CPA, or JD, our college planning associate, or Casey Taylor, who helps with real estate and mortgage needs. More recently, the lower level of your screen were professionals over the last 2 or 3 years we've added. Taylor Watcott joined our organization earlier in 2022 with an emphasis and specialty in insurance, specifically in your home and auto and business insurance. The Phelps LeClaire estate planning team have been tremendous partners. We brought them in back in 2019, and they are estate planning specialists in our offices. And Lisa Martin joined us at the end of 2020 as our healthcare specialist, dealing in everything non-Medicare related. So I wanted to say a special thank you to them. Also, I wanted to make sure that you know that we have these resources here. And again, these are more than just people that we refer to. They're all people that we work with and are very trusted professionals in our circles and in our offices, so that we can really help coordinate and have an impact in your world. So if there is something you need in one of these areas, please let us know. We'd be happy to pull them in. All right. So getting to the agenda for this afternoon, our focus in the first part of the session will be really 2-part. We want to review the economy, what happened in 2002, and the financial markets. Those are going to be the focus areas in the first section. And then we'll move on to what may be ahead as we start to think about 2023. Wow, 2022, what a year. And as we try to put this together and think about how we wanted to antiquate this and how it really was, this picture kind of sums it up. We've all been on a flight that we hit turbulence and we were uncomfortable and white-knuckled the chair next to us and thinking, oh my God, will this plane land? Will I be okay? Well, that's kind of like what 2022 was for investors. There's so many uncertainties and so much volatility that came throughout the year. And we heard from many of you throughout the course of the year of, my gosh, when is this going to end? And all these uncertainties that kept coming out, whether it was the Federal Reserve raising interest rates or the war in Ukraine and COVID and China and the labor markets and supply chain and inflation, all these things. So the good news is, while this turbulent market and these flights are bumpy and they're uncomfortable, it doesn't stop us from getting for our destination, right? And if it did, we wouldn't be here talking about it, right? The bad news is there's still a lot of uncertainty, and we're going to talk about some of those things that might be continued uncertainties that will linger into 2023 and may continue to cause some volatility. Well, let's think back a year ago, right? The uncertainty that I just mentioned is heavy. And if we go back to the end of 2021, and we really didn't put it up here, but we came out of a period in 2020 and 2021 where uncertainty was already high, right? COVID had caused mass shutdowns in the United States, and people were working from home, not working from home. Schools were shut, schools were open. All sorts of uncertainties continued coming into the year. And then we came into 2022, and the first big one that hit the year was Russia invasion of Ukraine. And while there may have been a few people out there that saw this coming, by and large, this was pretty unprecedented in a modern age that Russia would roll tanks across the border and invade Ukraine. And right on top of that, China, which had this zero COVID policy, was moving from full shutdown to zero shutdown. And we came into 2022, and China had started to reopen their economy. And in the early part of February, went back into a complete shutdown and had millions and millions of people in complete shutdown. And right behind that, and somewhat caused or at least accelerated because of the war in Ukraine and the policy in China, inflation really started to take hold. And we're going to dig into that a little bit more. And then immediately in March, we saw the Federal Reserve pivot and start to raise interest rates. And we're going to talk about all four of these things and the impacts that they had on the markets in 2022. But let's start by looking at inflation. Now we're here, we know what was happening here, but this inflation issue is not just an issue for the United States. And what we have on the screen here is a picture of a globe, kind of a heat map, if you will, and it's color coded. So the red areas that you'll see, the darkest red, were inflationary areas that were more than 50%. 20 to 50% is kind of the red apple, cherry red apple. And then you can see the pink and the light pink and the blue. But when you look around the globe, the inflation impact around the globe was rampant. Venezuela at 73% inflation, Turkey at 155% inflation, 73% in Argentina, 285% inflation in Zimbabwe at the highest point of the year. You'll notice there's also some small areas that are blue, which means they had inflation less than 5%, the largest of which you might recognize being China. And I'm not really sure we can trust the data that's coming out of that region of the country. But the point is, this inflation issue was an issue that was all over the world. And then central banks started to raise interest rates. And again, we have to go back a year and a half ago before 2022 to really, I think, understand the impact. We came into 2022 with the Fed policy and interest rates set at 0%. Mortgage rates in January and February and March of 2022 were 2.5% for a 30-year fixed rate mortgage. These were unprecedented lows, and we can see on the chart there, you can see the interest rate cycle, how low it was. And it wasn't just here, but it was also around the globe. And what we have up here is a chart going back to 1970, roughly 1972. So you can kind of see where interest rates have been in the Fed target rate. But we came into the year at 0%. The Fed had an unprecedented year, 7 rate increases in 2022, 4 of which were 75 basis points, 4 in a row, 75 basis point increases. We'd never seen this before. The last Fed meeting that we had in 2021 leading into last year, the Fed said that they thought they might have to raise interest rates at least one time in 2022. So again, if there's one thing we know that all these things cause, is it certainly causes uncertainty. And when we look back on 2022 and what the central banks said, not only here in the United States, but around the globe, it was the fastest pace of increase in history. And it's still happening. So, February, all of our numbers here were through the end of the year. The Fed rate was at 4.33%. The Fed just met last week. They raised another 25 basis points, or 0.25%. And the prediction is that they'll see 1 or 2 more increases as we get through the next couple of months. But on top of that, quantitative easing, tightening also started to happen. So it wasn't just the Federal Reserve raising interest rates. A lot of what the government did to help us get through COVID, they started to unwind through this process of quantitative tightening versus quantitative easing that they had done in 2003. And what about inflation? Well, and these two things are directly related. The Fed's goal, their primary target, is to help manage inflation. They currently have a target rate of 2%. What we wanted to show you is what happened through the course of 2022. So this is a graph of 2021 all the way through the end of November of 2022. What you'll see there in the middle of your screen is inflation peaked last year at about 9.1%. And what these numbers are, we get these reports every month, and they're the CPI report year over year. So in June, the inflation figure for June was 9.1% year over year. That was the peak. What you'll notice, and on the front half of the year, we saw incredible increases, especially from January, that December, all the way through June. What we did start to see on the back half of the year is inflation going the other direction, right? The September reading was 8.2%. The November reading was 7.1%. December's reading was in the 5 or 6.8%. And we've seen even that come down a little bit more as we've gotten into January. So the good news is that as we look at this, is this impact of what the Federal Reserve did, which on the previous screen we discovered, we've really started to see an impact in inflation, in particular in these areas. I was reading an interesting article just yesterday talking about used cars, and this has been a common conversation with clients, right? Is everybody, within our client base, this is something that people have to deal with every handful of years. It was difficult in 2022 to find a used car. New cars were selling at $20,000, $30,000, $40,000 over sticker for a new car, but the used car market was incredibly high and hot as well. I read an article yesterday saying that used car pricing year over year was down 15.5%. So the point is, we're starting to see an impact on these inflation areas, and it's not in all areas, right? I mean, just this past week are talking about, a dozen of eggs costing $10. And so it's certainly not gone in totality. But in general, when we look at the big numbers, we're seeing inflationary pressure start to ease, which is part of what we believe will help drive things as we continue into 2023, which we'll get into a little bit later. I also think it's important to touch on housing. Arguably, when the Federal Reserve changes interest rates, the asset that's closest correlated to interest rates that we all have arguably is your home. And when interest rates go on a 30-year fixed mortgage from 3%, which they were back in March and before of 2022, all the way up to 7.8%, the 30-year fixed mortgage at the end of July hit 7.08%. Now it started to ease and come down. And today I pulled the national average, and at least as of today, the national average for a conforming 30-year fix was about 6.56%. But that impact is going to directly impact housing. We've already seen it in most of the major metropolitan areas. We're going to talk about consumer spending in a little bit and the impact that might be happening in some of the numbers we're seeing in people spending money on their homes, because it's certainly starting to have an impact. Along all these things, 2022 was a robust year for job growth. And we've got a chart here going back to 2013, and you can kind of see those job growth as it went. Just notably, you'll see the iceberg that occurred back in Q1 of 2020. That was the pandemic, and the amount of increase in unemployment that occurred. It was pretty short-lived. But 2022 ended up being an amazing year. We added 4.3 million jobs in 2022. It was the second strongest year in job creation since 1939. Now, many of us have been asking that question, and you're going to hear it on the news tonight. What about a recession, right? And that's been the major concern, and maybe a big reason why the markets were down so much last year, not only because of all these uncertainties, but these massive concerns around, will all these things force us into a recession? And this is important. Job creation is incredibly important. There's only been one recession in economic history where we saw job growth this strong, where we still saw a recession. Unemployment rate ended last year at 3.7%, which is incredibly close to a record close. Now, since that point, again, we're here in February. Just last week, the jobs number came out. What was expected was 187,000 new jobs for the month of December, January. What we ended up having was 515,000 new jobs created for the month of January. So the good news here is we're seeing incredibly strong job growth. We track this figure. This is one of the reasons why we believe that the odds of seeing a recession and really a double dip correction is incredibly low. Job creation has been strong. Now, it's interesting because you hear on TV, these massive tech companies that are laying off 10,000 people. And I think it's important to understand that while there are large organizations and there's going to be pockets of the economy that are going to need to lay people off. Housing, we talked about housing and mortgages. One of the areas that we're seeing continued layoffs are in that area, and that will probably continue while rates are where they are. But when you look at the total labor market and you look at what's normal for attrition and layoffs and those types of things, 2022 from a whole, and even looking more recently, layoffs were incredibly low as a part of the entire job market. Now, it doesn't catch the headline news like, a company laying off 10,000 people. That's headline news, and the media likes to report on that. But overall, the economy and the job market is incredibly strong. Along with jobs being strong, real personal income adjusted for inflation rose. It rose at 1.4%. Now, this is something we haven't seen for many, many years. Wage increases have been stagnant for a decade, really since the 08-09 recession. We haven't seen much in the way of real personal income adjusted for inflation. And what you can see in this chart is we saw really good personal income increase. And again, that's not just people making more money, that's adjusted for inflation. So above and beyond that those heavy inflationary pressures that we saw last year, above and beyond that, we saw real wage increases along with it. And along with that, the consumer spent money. And what you can see here is a chart of consumer spending. And this is incredibly important. 2/3 of the economy here in the United States is based on and driven by consumer spending. This is a really big deal. And personal consumption and spending increased for last year. It accelerated most of the year while people bought cars, they bought trucks, they went back out to eat, they started to travel more. And we did see some spending start to slow at the tail end of the year, which is something we're going to have to continue to watch. So just looking at that a little bit deeper, looking at quarter by quarter, the economic or educational definition of a recession is 2 negative quarters. Well, we saw that. Q1, we had negative economic growth of 1.6%. Q2 was negative 0.6%. Q3 came in at 3.2%. We didn't have these numbers when we pulled the slides together, but Q4 economic growth was about 2.9%. So it's interesting because there's this debate about recession. Well, technically, Q1 and Q2, we saw it. And we talked about this at our halftime report last year. One of the biggest things about Q1, if you'll take your eyes there, if you go all the way down to the bottom, net exports were down 3.13%. Almost every other category was positive, but we had a huge reduction in net exports. Most believe that was directly a cause of the economic shutdown in China. So China's government had a zero COVID policy at the time and went into lockdown about a month into the first quarter of last year, and nobody could leave their homes. And that impact we felt with regards to our net exports. You can see that rebounded strong in Q2 as China started to recover. And in Q3 and in Q4, what we saw is the Chinese economy was pretty much back to open, and they've at least this far kind of gone away from that zero COVID policy. So the good news is we've seen positive economic growth. We didn't see it in Q1 and Q2, so we technically met that definition of recession, but we are seeing economic growth decline here from Q3 to Q4. But again, one of the goals of the Federal Reserve is to slow things down, right? The only way for them to slow inflation is to curb demand. And so by raising interest rates, they're making things a bit more expensive and trying to slow that down. So that would be an expectation that we would expect to see. GDP growth will probably continue to slow as we get through the next couple of quarters. There's a lot on this chart, and I'm not going to go into a crazy amount of detail here, but these are economic indicators the central bank look at. And this looks at manufacturing from around the world, and it goes back from September of 2021 to going left to November of 2022. And what this is trying to gauge is economic growth or economic contraction. Anything on this chart gauged at a 50 or higher is economic expansion. Anything at 50 below is kind of the cutoff between expansion and contraction. So what you can see here is many of these manufacturer countries around the world have gone in, from aggressive growth or expansion into contraction. Again, part of this might have been forced by the Federal Reserve raising interest rates and some of those impacts. Again, another important area that we think we're going to have to continue to watch. As we always do at our forecast event, our halftime report, we like to lean on some famous people that you might recognize and to pull their quotes. This was a great quote from Jordan Yadu from Bloomberg, just talking about the threshold from expansion to contraction. And really, since the first time of the pandemic lockdowns, we've seen that started to separate. Again, something we'll have to continue to watch. Job openings, hiring, separations, and layoffs. We already kind of touched on this, but late in the year, we started to hear more reports about companies laying people off. But this is a good thing. The Federal Reserve, many times throughout the course of last year, has said one of their concerns is the labor market and how tight it was. And we're a small business, but I can tell you, as we're trying to hire people to add to our team, I can't remember a more difficult period than the middle part of 2022. We would put out a job posting and get maybe one or two applicants, where traditionally that same job posting might solicit 20, 30 applicants. What we are seeing today is those numbers have come back in line with what we would expect to see, and we're seeing 20, 30, 40 job applicants for every job that's out there. So we're going to have to continue to watch this, and it's something that we'll have to monitor. We touched on this slightly, but home prices and rents cooled dramatically, and I think this really depends on maybe where you are in the country. Phoenix has been known as one of the fastest growing markets in the last few years, and now that we're seeing slowdowns, it's probably a little more aggressive. These numbers that we're showing you here were national home prices, and basically what we found at the end of October, year over year, home prices were still up about 9.2%. But when we shortened that and looked at 3 months, quarter over quarter, at the end of October, we already saw about a 2.7% decline. Most of the numbers that we're seeing today would show that we've seen about another 5 to 10% correction from the high part of the year, which is about middle part of the year through the end of the year. And also, apartment rents have come down. This is a really important thing that the Fed has been focused on. Home affordability was getting out of control. People were struggling to find places even to rent. And again, something that the Federal Reserve really wanted to get under control. Again, Dr. David Kelly, many of our advisors, we buy his research, so we often talk about Dr. David Kelly and all the research that he does. But this is one of those things where he says, this might be a reason why the Federal Reserve actually pivots and maybe even cuts later in the year. If there's too much of an impact to housing, we might see them do something different. So what's ahead? And while nobody knows, we always like to pull some famous people and, again, big organizations. And you've probably heard these terms that are on the screen here. The media likes to use them. Are we going to head to a soft landing? Is there going to be stagflation? Or are we going to see a recession? Now, this was done back at the end of the year. And at that point, the Wall Street Journal surveyed a bunch of economists, and they found that 63% of those economists surveyed thought that there was a chance that we could see a recession in 2023. Now, there's an old saying that says, when everybody's thinking the same thing, someone's missing something. And it's interesting because usually we don't see these kinds of numbers get this high between stagflation and recession. But as we're going through 2022 and you have all these negative things happening, it's hard to paint a different picture. And while nobody really knows, in December, 63% thought we'd see a recession. 92% thought we'd see stagflation, where basically we just see slower growth and a little bit higher inflation. And that might continue beyond 2023. 35% thought we'd see a soft landing, which would mean that the Fed gets to where they want to go. We see inflation come down and we avoid any sort of recession. And we see these higher inflation rates go away. Today, what they're talking about is somewhere in between soft landing and stagflation, where maybe there's not a landing. Maybe we don't see a hard landing or a soft landing, but maybe what we see is inflation does get under control and we continue to see economic growth in normal levels, and we have something in between. So obviously, these are things we're going to have to continue to monitor and watch. We always like to talk about the yield curve. A lot of our clients say, Trev, why do you talk about the yield curve? It's so confusing, and it just confuses me. We always have a little internal debate about whether we should talk about this or not. But a lot of the media likes to talk about it. An inverted yield curve, which basically means that short-term yields are higher than long-term yields, which is not normal, and historically shows that there's a higher potential of seeing a recession. And we have continued to see that yield curve stay inverted. We've got a chart here going back from 1 month all the way out to 30 years, and you can kind of see that the shorter maturities on top, longer maturities on the bottom. We're going to have to continue to monitor that. But does that mean recession, right? And so what we went on this chart is we went back and looked at the other times in history where the yield's been inverted and what did happen. Most of the time, there was some sort of recession. What I find is really interesting about this chart is on the far right of this screen, it shows you when the recession started and when it ended. And while there were a few periods of time where that recession lasted, beyond a year, not very many times. We already talked about the fact that we saw negative GDP growth in Q1 and Q2 of 2022. And again, today, February 8th, we're almost a year into this thing. In fact, the general markets hit a high about 13 months ago coming out of 2021. There's a chance that we've already been through the worst of this. But again, this will have to be something we continue to watch and something we continue to monitor. Yogi Berra, we always like to quote famous people, as I've mentioned a couple times. And I just really love this quote. He says, it's really tough to make predictions, especially about the future. And while we think about that and what all these people are predicting, the reality is if it was that easy, it wouldn't happen. The Federal Reserve and smart people would do things that they can to avoid these problems. What we like to focus on and what we want to talk about as we go through the back half of this presentation really is a couple of things that we try to focus on. And those things are process, planning, people, and patience. Right? We've got to have a plan. Our team of advisors, your advisors work incredibly hard to meet with you, understand your needs, your goals, and to create a plan, not only in the form of a financial plan, but an investment plan that will meet those needs. We've got to stick to that plan, and we've got to be patient. And certainly 2021 was one of those years that test our patience as we got through that year. Well, we've covered some of the financial indicators of 2022, talked about interest rates, we've talked about inflation and jobs and the impact there. What we want to do is turn our attention and look at the financial markets. Not a great year to say the least, but we'll start with the Michigan Consumer Sentiment Survey. If you go back to 2021, what this survey actually is gauging consumers about how they feel about things. What is interesting is this is known as a bit of a lagging indicator, and it'll make sense when you understand it. So back in December of 2021, the consumer sentiment report or gauge marked 70.6%. So we had just come off 2021. We obviously 2020, we saw the rebound from the decline due to COVID. 2021 was another positive year in the general stock markets, by the way, which also was leading into about 13 years of good markets coming out of the last major recession that we had back in 2008 and 2009. Consumer sentiment survey hit 70.6%. Fast forward to June of last year, that survey had declined all the way down to 50%. And in December at 59.7%. So clearly consumers weren't feeling very good. And well, how could you? When you're going through a year like last year and your investments are struggling, the general markets are down, and every night on TV is something negative. And we didn't even talk about this, but the final quarter of the year, we had a election. And so we get the disruption of and the uncertainty that gets added with an election and all those things that come into it. But consumers didn't feel great. So a little bit longer term look at this. And again, as I mentioned before, these surveys are often known as a contrarian indicator, meaning when too much of the population is feeling really good, that's probably a time to start getting conservative and thinking differently. And on the flip side, when bearish sentiment, when people are so worried about things, maybe that's an opportunity. And what you'll see through the course of this slide, the green level is the end of 2022, and bearish sentiment was at the highest point that we've seen in quite some time at the end of this year. Optimism was low. This may actually be an indicator that the bottom had been set and it's time to move forward. The stock markets were turbulent, and we've talked about this in years past. We always kind of like to look at the volatility, but last year was a crazy volatile year. We had 122 days where the markets moved up or down at least 1%. 46 moves of 2%, and 12 times throughout the course of the year where the markets moved, increase or decrease by at least 3%. Statistically and historically, these are not normal numbers. And to make it worse, the previous years really leading out of COVID, we were seeing the opposite. We saw very low and traditional kind of correlated days. We didn't see a lot of these big moves up and a lot of these big moves down. 2022 was filled with them. And so to add to the anxiety, every night when we came home from work or you were settling in after dinner and turned on the news, the flash on the TV would be markets crash, markets boom, markets crash. And that emotional trigger was really, really heavy last year. The Economist, this was a kind of a great quote we found in December. The slump in the markets around the world this year has been painful. The MSCI's broadest index of global equities is down 18%. As is the S&P 500 index of America's biggest firms. It's not just shares that have suffered. Supposedly safer assets have not escaped the rout either. And there wasn't a lot of talk about this because everybody talks about the general market, the S&P 500, the NASDAQ, which was down closer to 30+%. But the bond market, AGG, large corporate high-grade bonds had the worst year ever. 2022 for the bond market, which is the safer part of your investment portfolio historically, was down close to 17%. It was the worst year ever for corporate bonds and really all bonds, including municipal bonds and government bonds. So it wasn't just that we had this abnormal reaction or this crazy market volatility in the stock market, but bond markets had the worst year ever. Now, that was directly correlated to what the Federal Reserve did in raising interest rates 7 times. This was an area that we talked a lot about coming out of 2021, and we made a lot of maneuvers in our portfolio, moving traditional corporate bonds to short-term bonds to avoid some of that volatility. And it certainly helped, but it didn't necessarily make the difference. So here's how it ranked for 2022, and you can kind of see how on the far right, how bad everything was. Unless you got lucky enough to put everything in the energy sector, everything was down. Large cap growth down 40%, small cap growth down 20%. S&P 500, the largest 500 companies in America, down 18%. International down 18%. Telecommunications down 40%. Russell 2000. Just across the board was just a very, very brutal year. Don't need to go through this because most of you already know that it just wasn't a very fun year, but it didn't turn out so good. But there are expectations that earnings are going to grow. Another good quote from John Butters from FactSet back in December. Despite concerns about a possible recession next year, talking about this year, analysts still expect the S&P 500 to report single-digit earnings growth in 2023. The estimated year-over-year earnings growth rate is about 5.5%. So what's interesting is there's a lot of concern. And look, stocks coming into 2022, last year, stocks weren't cheap. Again, we had a very strong rebound out of COVID and a continuation of that in 2021. And quite frankly, outside of a couple of flat years since 2009, hadn't seen much in the way of down cycle. So part of this might have been the markets were just overdue for some sort of a normal correction. But we'll have to continue to watch this as we're going into 22. There are some expectations that there will be an earnings recession, and we'll have to continue to watch this. Again, we think that there's a lower likelihood of this due to employment being as strong as it is, but we'll have to continue to watch this. So the price earnings is just what I was touching on. If you look back at that slide, right now the average price earnings ratio of the S&P 500, this is at the end of the year, traded at about 19.97%. But we came into 2021 with a price earnings ratio closer to 35 times earnings. So although things are still not at the low end, they're not, I don't know that you would call them cheap. Valuations have come much more closer to in line with where they typically are, which are somewhere in the 15 to 16 times earnings. Again, we'll have to continue to watch this. Cape-Shiller ratio, again, this is another ratio that's used to try to help look at values and how are things valued, adjusted over a little bit of a longer period of time. And what you can see in this chart goes all the way back into the 1800s, late 1800s. While valuations are still at the high end of the range, they're nowhere near the peaks that we saw at the dot-com bubble, which was back in 1999, nor where we were at the end of 2021, and really even all the way back to 2019. So this could mean that there's less risk in the markets and a little bit more valuation, better valuations today than there were a year ago. Obviously, earnings will continue to drive some of this as we watch what happens. This was a really, and I touched on this earlier. Most people are aware of how bad it was in the stock market. There was very little discussion around the bond market. And this graph goes back to 1976 and is a graph of annual returns on the U.S. aggregate bond market returns every single year. And you can see how rare it is to see a negative year. There's been 3 times in history where the bond market was down. The previous 3 times, down 2.9% in 1994, down 0.8 in 1999, down roughly 2% in 2014, and last year down closer to 13, almost 14% for the full calendar year. Not a lot of talk about this, but just again, the worst year in history for the bond market. Now, there is a direct correlation here between what happens in bonds and what the Federal Reserve has been doing with interest rates. We call it the teeter-totter effect. As one side goes up, the other side has to go down. And on one side, you have the price of existing bonds. On the other side, you have interest rates, and interest rates went up 7 times. So, but there's a lot of people looking at the bond market and saying, wow, there's probably a lot of relative value. And again, just some positive things that were going to come from last year, interest rates went up. For the last 10 years, we haven't had safe assets to put investments into where we could see yields in the 4.5% or 5% range. We see them now, and we're talking to many of you about this. We're seeing short-term CD rates between 6 and 12 months in the 4.5 to 7 and 4.5 to 4.75. We've been picking up some 3 and 5 year fixed contracts north of 5%. We haven't had the opportunity to do that in a long time, and so there will be a lot of positives that are going to come from this as we wait and are patient for recovery, where we will have the opportunity to reset and de-risk some of the portfolio and lock in some of these interest rates at higher rates. And we haven't had the opportunity to do that for many years. I also want to take just a quick second to urge you to think about your cash management. Most of our clients, about 90% of our clients, bank with big banks, Wells Fargo, Chase, Bank of America. And what we have not seen out of the big banks is any change in the interest rate that they're paying you in your savings account. It's still well below 1%, even if you're keeping $100,000, $200,000, $300,000 in those accounts. So what I've been urging clients to think about is really think about your cash management and your emergency reserves in more of a calculated fashion. Pull out a calendar. do a mathematical equation of how much money might you need over the next 6 months. Well, that money should stay in cash, but maybe it should go to an online bank. There's many of them out there. The one I happen to use is the American Express High Yield Savings Account. The current yield is somewhere, annualized yield is in the 3% range. It's FDIC insured. There's no restrictions, but that's a lot better than getting 0.08 at Wells Fargo, which is where I also bank at. But the other part of it, and this is where we might be able to help you, is we're seeing really great interest rates on 6, 10, 12, 18-month CDs. So if we know that there's some money in your savings or emergency reserve that you're not going to need for 6 or 7 months, maybe we should consider buying a 6 or 7 month CD. The interest rates that we've seen on those 6, 7 month CDs have been somewhere between 4 to 4.45%. 12-month CDs are right around 4.75%. So maybe that's an action to take a look at. If you're in a position where you think you have some money, call your advisor, let us know. We can help you search through that and see if there's something to do. On this slide, we looked at a 60-40 portfolio. So 60% of your money being in equities, 40% of your money being in fixed income. And we went back historically. And again, following that type of methodology, there was very few years where you lost money. 2008, you would have been down 21%. You can kind of see it as you go through. Last year, that standard 60-40 portfolio was down almost 17% before any fees and expenses. So again, the question is what's going to happen next? Are bonds going to continue to disappoint? Our belief is that the Federal Reserve gets to a point where they decide to pause interest rates, and we're already seeing them, go that direction. Again, they raised interest rates this month by 25 basis points. They did 50 basis points in December. So they seem to be heading the right direction. We think that bonds actually could be a very positive asset class. So back to that flight, right? We're on that plane. We made it through the turbulence, right? We're heading across the country. We had a really uncomfortable 30 minutes going through turbulence, and the plane was popping up and down, and we felt like we might throw up, as some of us did last year, but we made it through it. Well, what we want to take the last few minutes out here is look at what we might be dealing with as we get into 2023 and what might be ahead. Well, the first thing is, how long will this bear market last? Right? What we do know is, we went through a more than 20% decline, which classifies 2022 as a bear market. So we wanted to look at what's happened historically, and you can see the dates on the screen. These are all of the classified bear markets that we've seen historically. Interestingly enough, even though last year did not feel normal, when you look at the average decline and the median decline, it about falls in line. The S&P 500 was down just about 20%. Now, what we don't know is how long will it take to get through it. Now, you can see the longest period of time that we went through historically was 1976, and that period took 17 and a half months to get through that period of time, the bear market, right, top to bottom. But the average was about 5.8 is the median period of time that it took to go from peak to trough, and the median was 7.1 months. And if you look again historically at what occurred, this one already has fallen into a little bit more of that longer term average. But what happens after that? And what we found historically is stocks tend to do very well after correction. So we went back on those same periods of time and said, okay, well, if we went back to those periods of time and said, okay, well, what happened a year after the market hit their low? Okay, in 1987, the general market correction was 32%. That was one of the more serious corrections that we've seen historically. 1 year following that decline, that low point, the market was up almost 23%. 2 years, it was almost up 52%. The average, and you can go through the numbers on your own, there was only one period of time historically where a year later the market wasn't up, and that was in 2001 when 9/11 happened, and there might have been some other influences there. And only one other period of time where after 2 years the market wasn't up. But the average, the median return 12 months after the market hit its bottom was 23.5%. 24 months later, the median return was 36.2. Now, I know it's a volatile year. It's been a very scary year to get through, but the patience and the follow the process is an incredibly important part of this. Historically, what we've seen is people, when people finally get to that point of capitulation where they say it's time to call and say, hey, get me out, typically represents a market bottom. We saw an awful lot of that happening, not necessarily with us, but across the industry right at the end of 2022. And we've already seen a significant rebound and recovery as we've started 2023. If you're having those kinds of concerns, we want to talk to you. We want to help you work through it. But what history would show us would be the recovery that happens on the back half or the other side of these corrections and bear markets is significant. And if you're in, you benefit from it and recover. If you decide to get out and move away from it, historically, you don't recover at that same pace. And in many cases, you'll never recover. So I hope that helps. Again, a top-down analysis of 17 Wall Street strategists' predictions showed that the average S&P price target for 2023 is 4,009, which represents potential upside of less than 1%. Now, this was on December 9th of 2022. As I sit here today on February 8th, the S&P 500 is already up about 8%. So most of these 17 analysts were wrong. As we've talked about before, it's very hard to predict the future. Another good quote, some of the biggest stocks will see low double-digit returns for the next year. The Federal Reserve could soon start to change its tone. 71% response in Bloomberg surveys expect equities to rise versus 19% forecasting decline. So many people are thinking that we will continue to see that recovery into this year, but we're going to have to continue to watch that. What about growth projections? What's going to happen around the globe? Well, you can see what's been predicted from a global economy. The expectation from the International Monetary Fund is growth of 2.7%. Advanced economies like ours are expected to grow at 1.1%, and emerging market and developing economies are expected to go at 3.2%. GDP will be important and will probably continue to help drive, or at least should help drive the general markets, but we'll have to continue to watch this. Debt is interesting, and this quote, we wanted to put it on here because you're hearing more about people taking on debt and credit card debt and all these things. And this was just a good quote. While global debt remained above pre-pandemic levels in 2001, even after posting the steepest decline in 70 years, total public and private debt decreased in 2021 to the equivalent of 47% of global domestic product, falling by 10 percentage points from its peak in 2020. Expressed in dollar terms, however, global debt continued to rise, although at a much lower rate, reaching a record of $235 trillion last year. Now, we have to continue to watch this. We've had a lot of conversations. We often hear concerns about the debt that our government is taking on. The bottom line of what this quote is talking about is that the interest rate, it's less as a percentage of the GDP. Even though the debt has grown, the cost to repay that has gone down. And historically, at least looking at the United States in particular, and really the globe, this is what's happened. The globe has grown its way out of debt, so that your debt, if you wanted to think about it as an individual borrower, your debt to income, your income has always grown at a higher rate than the debt. But we have to continue to monitor this, and this obviously could have an impact as we go through. As a measure of U.S. national debt, $31.4 trillion. It's hard to even say it. I remember we did this for a halftime event in 2013 where we had the U.S. debt clock up on the screen, and you could see the trillions of dollars or hundreds of millions of dollars just ticking by seconds. Well, here we are at 31.4 trillion, and it represents 137% of our GDP. So we're going to have to continue to watch this. This will cost our economy, and we're going to have to, again, monitor this as we go. So what are the pros saying for 2023? And again, we always like to pull some important people. This was Rich Miller from Bloomberg. The Fed Chair Jerome Powell and his colleagues have been quietly setting the stage for a soft landing. The monetary tightening campaign is having a majority impact as assets during the first years of the pandemic, favoring technology stocks, have tumbled by more than 50%. Red house housing stocks have fallen the most in 10 years. And most importantly, all of this is occurring without upending the financial system. He clearly believes that we're going to be landing in a soft landing, as he put it, and avoiding a severe recession. Again, Mohamed Al-Aaron, a very well-known economist and speaker, the world may be experiencing major structural and secular changes that will outlast the current business cycle. The new trends, in particular hints of such transformation, are likely to play an important role in shaping the economy over the years to come, shifting from insufficient demand and to insufficient supply, in the balanced liquidity from central banks and the increasing fragility of the financial markets. He's certainly more concerned about recession and some of those things happening. Patrick Fowle talks about the gas and oil markets and the impact of renewables and what that could have in the U.S. markets. Liz Ann Saunders, managing director at Schwab, the Federal Reserve's ongoing commitment to raising interest rates to cool inflation is likely to lead to a weaker U.S. economy in 2023. However, Fed policymakers indicate they are looking at an eventual pause in rates, possibly mid-2023, that is likely to have the federal fund rate target remain at its peak terminal rate for some time. In other words, they believe that they're going to be able to get it. The U.S. Economy has improved, and the economy will continue to grow. Now, we'll probably have to work through 2023, but looking back through 2021, we saw economies recover at different speeds. It's worth noting that emerging markets were fairly quick to deal with inflation last year, so they're getting very near the end of their tightening cycle. I think this is a theme that we're seeing and hearing more and more about since the end of 2022. Here in the U.S., again, the Federal Reserve has cut its rate hike to 25 basis points. We're seeing other countries around the globe. So the good news could be that we could be at the end of this tightening cycle. That could be a very good sign for bonds and for stocks, of course. Well, while none of this feels normal, we do think that there's some basic things that we would try to encourage you on. And that's number one, avoid making a fear-based decision. What we do know is, I've been doing this for 22 years, and we've gone through these cycles of euphoria where things feel good, and we've gone through these periods of times where it's painful and it's scary. And the human emotion behind those is typically the opposite of what it should be. When times are great and euphoria set in, people want to get more aggressive. When times are scary, like 2009, when the economy is in the dumps and housings are, foreclosures and everybody, that's when we should have been thinking about trying to take advantage of it. Our focus will be and is on positioning the best way we can to retain the balance and to recover as we get through the next economic cycle. I said this before, but staying the course is important. We spend a lot of time, our advisors spend a lot of time with you and with our analysts and using software programs to help create a proper plan to not only meet your needs, but to create an investment plan to meet those needs. And staying the course is incredibly important. Oftentimes when people deviate, it's when they get in trouble. Keep your eyes on the end goal. Just like taking that plane flight across the country, we certainly hit some turbulence and it was scary. And maybe some of us even threw up in a little barf bag as we made it through that turbulence, but we survived it. And the focus now needs to be on getting to the destination and focusing on recovery. Trust the plan. As always, be mindful of spending. People often reach out and say, well, what's the one thing I should do right now? And the reality is, if you don't need it, don't take it. Be cautious about where you spend your money. If you can take less money out of your portfolio to allow more money to stay in for recovery, that is the proper answer. So be mindful of that. Help us make good decisions with your money. And more importantly, as I mentioned before, we want to stick to the 4 Ps. It's about process, it's about patience, it's about people, and it's about progress. I want to thank you for your attention this afternoon. We hope that this forecast event has been worth your time. We are excited about presenting our halftime report in August, as we will have an opportunity to review the first half of this year's events. I wish you and your family a safe 2023. Again, I want to say thank you. Without your continued support and referrals, our organization would not be able to do the things that it can do to help support our clients and our community today. So thank you. And again, have a great evening and happy 2023. Goodbye now.